everyone. I'm Gene Trowbridge of the Trowbridge Law Group, and I'm here with our Facebook post for this week. And Trowbridge Law Group, what are we? We're a firm that operates in the area of securities laws, business law, real estate, doing LLCs, private placement, memorandums. We do everything from start to finish. If you're raising money from a group of people to make an investment, Trowbridge Law Group. Today, my message is the sponsor committing fraud? That's the message. And the answer very quickly is yes, they are, if they're just returning investors' capital and telling them that that distribution is a return on their investment. Okay. And I see this frequently in the industry. People come to us and ask us to write offerings, and they have some idea how they're going to send people checks before the property is really up and running. You get a value add property, and for maybe 16, 20 months, all you're doing is rehab, and you're having tenant turnover, and you really don't have positive cash flow. Well, how the hell are you sending out checks? What is that? And they have all sorts of schemes on this. And unfortunately, I won't write those offerings, and I have to educate the sponsor that they're probably committing fraud if they continue with their plan. So how does this work? Well, I'm using the example of a savings account in the bank. You deposit $100,000 in a savings account, and it's paying 10% a year. At the end of the year, you go to the bank and there's $110,000 on your account. You take out the $10,000, which is the 10% return on your money that the bank paid you. You still have $1,000 in your account. You haven't taken any of your money out. And you can say you earned 10%. Your $100,000 earned 10%. But what if you took out 15,000? Can you say that the savings account earned you 15%? No. You took out the 10% it earned. That's your return on your money. And you took out $5,000 of your own money. You made a distribution. That's basically 15% of what you originally invested. But at the end of that year, you only have $95,000 in your account. You took what you earned and you took some of your money. Now you can bring that over to the real estate world, and we need to make sure that when a sponsor says, here's your return for this quarter, here's your return for this year, that they're giving you money that the property earned, not just giving you your money back. And so how do I see this happening? I see this happening when the sponsor simply raises more money than they need to do the deal, and then plans on using that extra money to write checks to you until the property starts earning money. Let's say it takes $1 million to buy the property and do all the things you want to do, and the sponsor decides that he's going to raise $1,100,000, and the $100,000 that comes from the investor is going to be used to send checks out while the property is getting up and running. Well, you can do that, but don't tell the investor that that's a return on their money. It's not. The property never earned anything. What you've done is you've collected money from the investor, left it in the bank account, and then you just write checks back to them of their own money. And if in fact you don't explain what's happening, or even worse, you tell them this represents your yield on your investment, you're committing fraud. That is not a true statement, and you know it's not a true statement because you know you're just sending them their money back. Another place I see it is the sponsor makes distributions from reserves. You raise $60,000, $70,000 because you're going to need to replace air conditioning units in the next 2 years, and you promised a preferred return. At the end of the quarter, you're a little bit short on money that the property earned for you to send back as a preferred return. So you reach into the reserves for the air conditioning units and combine that money with what the property earned, send it to the investor and say, here's your 6-7% preferred return. No, it's not. Here's some money the property made, and here's some of your money that you sent us and we had set aside for doing the air conditioning work. First of all, that's fraudulent to tell them it's a return on their money when it isn't. And secondly, when it's time to do the air conditioning work, you won't have the money to do it, and the investors are going to be upset because the validity of your program and the strength of your property package was to redo the air conditioning units and make the project better. And now you can't do it, so that's trouble. And then whenever a sponsor tells their investors that the distribution is a yield, using either the terms cash on cash or preferred return, but some of the cash being distributed is a return of their money, those three things all cause the sponsor some trouble. What can happen to the sponsor? Well, if the sponsor actually is committing fraud, the sponsor could be liable for a civil lawsuit and or a criminal lawsuit. In the securities world, remember the securities laws are criminal statutes. So if you're committing fraud inside of the securities offering, you're in trouble. So I have some legal advice to you. My legal advice to you is don't do that. If the property isn't going to produce enough money to pay a return to the investors for a certain period of time, tell them that. Tell them we're not going to be distributing for 6 months, 8 months, a year until the property reaches 90% occupancy or whatever. Tell them that. But don't tell them we're going to just send you checks and know that the checks you're going to send them is really their own money. And now they think that the project is earning something. Don't do that. However, there are offerings out there where the investors are told that what they're getting is a return of capital. And only after they got all of their capital back will the next money they get actually be a return. In this case, the sponsor must use the term distribution rather than yield. And a good statement is you're receiving a distribution based on 10% of your initial capital investment. Okay, it's a distribution, it's not earning. Where would this come into place? Well, I've done offerings where it's a series of buildings. Buy some dirt, build a building. When we get it built, we get it rented up and we sell the building. Up until that point, there's been no distribution because there's no revenue. But when we sell the building, hopefully we sell it for more than it cost us to build it, we can send the investors some money back. And it really is a return of their investment. Okay. We might have raised enough money to build 2 or 3 buildings, but at the end of one building, we do have some money we can send the investor back. And then we build the second building, we send the investor some money back. Once again, just simply a return of their money. And then possibly the third building is free and clear. When we sell the third building, it's all profit. And so that does make sense. And in another situation, we have a current syndicator who makes distribution checks every quarter and tells the investor it's a combination of yield and return of. Generally, this sponsor's distribution is pegged at 12% a quarter or 12% a year, but based on a quarterly distribution. And the offering documents are very clear that we think we can distribute 8% from the earnings on the property and then another 4%, which will be a return of capital. So you're getting 12%, but it's a distribution. It's not 12% return, and it's not 12% cash on cash. So we cover that so we don't put that sponsor in the possibility of committing fraud on their investors. So investors should understand the source of the money that's coming back to them. They should look at the operating statement. And at the end of the first year, if the positive cash flow isn't possibly enough to make the preferred return, but the sponsor is promising a preferred return, maybe we should ask the sponsor, where's that money coming from? So the investors should know the source, and the sponsors should make it clear to the investors what the source is. One of the things kind of bugs me is when a sponsor says, well, I'm going to raise this extra $100,000 from investors, and then I'm just going to send them a check every quarter because they like getting checks. Well, I wonder if it's possible that they'd like not investing the extra $100,000 to start with. And one of the problems with that approach, let's say you only need $1 million, but you're raising $1.1 million and you're paying a preferred return. You're paying a preferred return on this extra $100,000 that you raised that never gets invested. It just sits there and is used to send checks back to investors. How's that going to work? That really is going to dumb down your overall return on the project because you've got $100,000 that never gets invested. Sure, the investors get a check, but they're just getting their own money back. If that's not clear to them, it should be made clear to them, and then an investor should decide, well, is that the type of deal I want to invest in? So that's my advice to you today as it relates to, is this a fraudulent activity on part of the sponsor? And this is running rampant. This approach is running rampant throughout the industry as we speak today, and I wanted to talk about it. So if you have any further questions, here's our general phone line. Here's my email address. My email address is gene@genetrowbridge.com, and our website is Trowbridge Law Group. I might suggest that you go to our YouTube channel. Our YouTube channel is YouTube at Trowbridge Law, and we have a lot of good interviews and talks like this that we post on our YouTube channel. So there's a lot of good information. So I'll see you next time at our next Facebook Live post.